Hey, everybody. Thank you very much for joining us for another episode of CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance. I'm Ken O'Deleger, and I'm joined as usual by my colleague, Gabe Selby. And we have a special episode for you today because we are also joined by our colleague, Peter Stern, who is the head of sales and business development and partnerships Americas for CF Benchmarks. Peter, thank you very much indeed for joining us.
Yeah, thank you so much for having me, Ken. I'm very excited to be on the podcast this week.
Wonderful, wonderful. And this is a particularly special one on a personal basis for myself and probably for Gabe as well, because Peter and I pretty much started at the same time at CF Benchmarks about 3 years ago. And anyone who is slightly aware of the history of the company probably knows how much the company has both changed and, of course, grown in that time. So it's one that we've been trying to put together for a while, and we're really, really stoked to have Peter on board. I think I would like to give a really, really short potted history of Peter's career, 7 years, I believe, pretty much doing investment management roles. As we said, he's currently the head of sales and business development, focusing on the Americas. He comes to CF Benchmarks previously from Bitwise, the digital asset first asset management firm in the States, which I'm sure is familiar to a lot of you guys. He also had stints at Payden Rygel, a business development at Payden Rygel. And he was also a mutual fund specialist at Eaton Vance, as well as an ETF product specialist at Deutsche Bank. So, you know, he's a seasoned investment professional. So, Peter, the thing that really springs to mind that, you know, the first question we need to ask you is what turned your head to crypto? Because really, this sounds like quite a conventional, institutional sort of career path. And then you suddenly jump ship and enter the mad and wild and wonderful world of crypto. Why did you do it?
Yeah, it's a pretty large change from fixed income to cryptocurrency. That's for sure. But yeah, I mean, it was, and thanks for the introduction, Ken. It was kind of stemmed from, I started out in, fixed income, relatively boring, plain vanilla. At Eaton Vance and Payden Rygel, very institutional. Just not, as you'd say, the sexiest side of investment management, but I saw the progression, from mutual funds to ETFs was kind of the first transition, and mainly with Deutsche Bank, it was the X trackers, the currency hedged products, and saw the transition one from mutual funds and separate accounts over to ETFs. So I wanted to get in that space first. So then I was able to make that transition. And then, it was probably I started following crypto around 2014, I would say. And then in 2015, I had a couple friends ask me, they're in more packaging logistics, and they had extra money from bonuses that they were trying to find where to allocate it. And they were obviously on the Bitcoin hype. I didn't understand crypto that well. I couldn't model it in a portfolio. I couldn't use Port on Bloomberg to figure this out. So I honestly hated it. And I thought this was just a Ponzi scheme. This is garbage. But I said, I can't be ignorant. I have to educate myself. So that's where I, went down the crypto rabbit hole back then. And that's where I was looking at Bitwise, and actually the head of passive products at Deutsche Bank had moved on. And then at this point, he was at Bitwise, and he, called me out of the blue and said, do you want to move to San Francisco for a year and essentially start, marketing this to advisors, institutions, in a cryptocurrency index wrapper. I thought it was still kind of crazy, but my wife and my mentor in the industry said, this is the time to get into this space and at least give it a shot. So that's, kind of how I made the transition to crypto. And then back from Deutsche, we worked with MSCI, FTSE Russell, S&P, the large index providers. And I have very close friends and ex-colleagues that work at those firms. So I wanted to make the transition into indexing. And that's where this blended everything together, cryptocurrency and indexing. So for me, it was the perfect role.
Yeah, that's brilliant. Now, you and Gabe, obviously, you're both stateside. So I'm going to let Gabe take it from here because, yeah, there's all sorts of ways we can go. But Gabe, you had some initial questions, I know.
Well, I just want to make a quick point that Ken, you and Peter here may have worked at CFB, at the same time, have a longer tenure, but it's very possible that Peter and I maybe cross paths even before then.
Maybe
in the Deutsche Bank world.
Yeah.
So we both come from that traditional finance background. And what Peter was saying about how he saw this technological kind of transition from the mutual fund vehicles over to the ETFs, something that, if you extrapolate this out into the future even further, it's on the crypto side, we're going to see, I think, more tokenization of real world assets. And that's going to be kind of a secular trend. As you kind of get to implement more of that blockchain technology. But no, Peter, welcome to our podcast. We're really excited to have you. We've got a lot of topics to, I think, cover today. And I think, for our listeners, we really want to give them just like a top of the rundown of who are some of these big players, who are some of the partnerships that you work with here in the US. I think some of our listeners might not have too much of an understanding of CF benchmarks and what we do here. So really be interested to kind of get that take from you.
Yeah. Thanks again, Gabe. And again, very happy to be here. So yeah, I mean, it's, as Ken alluded to, I've been with CFB for almost 3 years now. So, primary focus, at least in the Americas, has been with large institutions, traditional asset managers, similar to where you and I come from, just our previous background. So trying to educate them and trying to, provide, a service as the best index provider for crypto. And, the large asset managers and banks are the first targets that come to mind. And they have the sheer capacity and, the willingness to launch the types of products that we're used to seeing, whether it's a mutual fund or a separately managed account or it's an ETF. So that's where a lot of my focus is, as well as here, there is as we spoke, the Bitwises, the Grayscales of the world, the more crypto native asset managers is kind of really where I've spent a large majority of my time at CFB. And it's not just, within the Americas as in the United States. We have clients such as Evolve ETFs in Canada, as well as QR Asset and Hashdex, who Hashdex has been on the podcast as well. We've seen the Brazilian or the South American markets and the Canadian markets be much more willing to adopt crypto. So that's where, a lot of the initial focus was, and we've seen transitions over to, one of our largest clients, BlackRock, and their willingness to build a digital assets team and really put a lot of effort and time forward to learn the space as well as begin to launch products within that. So, I also do spend time with, more the asset owner space. We've had some conversations with endowments. We've spoken to some consultants as well. So pretty much the traditional gambit of the asset management, investment management world over here.
Yeah, I mean, I think it's super interesting because, from your perspective, you're dealing with, I would say, the largest, well-known asset manager in the world. You cover, like you were saying, America is the entire region. So you have North and South America, and you're seeing a lot of smaller asset managers who we partner with, who are in these regulatory regimes that are a little bit more friendly towards digital assets. And so you're kind of seeing a little bit of, the big versus small, the hawkish versus dovish regulatory regimes and all these different regions. No, it's just really, I think, interesting to get your perspective and hear kind of like what are some of the recent, discussions or dialogues that you're having with prospects or clients?
Yeah. That's a great question. And I think it's Canada and South America. I'm actually headed to Peru next week for a conference that
cool.
I think they kind of came pretty hot out of the gates. Canada specifically with Bitcoin and Ether, and then, have some multi-asset portfolios, but Brazil specifically similar. They came out with Bitcoin Ether, but quickly adapted the DeFi multi-asset portfolios, smart contract multi-asset portfolios, kind of what we really wish we had over here in the States. But still in the Americas, the primary focus has been Bitcoin and Ether. It's because, as you alluded to, the smaller organizations here can be a bit more nimble, and there's not as many people to convince when launching a product or kind of integrating digital assets, into their infrastructure, where the larger firms, it just takes a lot longer. They have a lot more people to appease in terms of, even getting to Bitcoin and Ether to have that conversation around how do you integrate that into a product, or just understanding it, or building a digital assets team, where also, though, as you said, Gabe, the most recent talks are a lot of people wanting to tokenize, already existing assets, real world assets. And I think it's partly because a lot of the firms don't want to fully dip their toes in and say that they're really dealing with digital assets from like an actual, down to the coin perspective. So it's, they don't want to necessarily deal with the reputational risk, which, of full blown, we're diving into this fully, where their tokenization of real world assets is a little bit easier, from a headline risk perspective. So that's kind of what we've seen. We've seen certain large firms that have really dove down the rabbit hole, and some that are still, cautiously optimistic around the space.
Yeah, we've touched on this already, because we're all fully aware here that there is an elephant in the room, and basically this is one question which a lot of people really want to know about. We are CF Benchmarks, and we, or rather you, Peter, managed to land only the biggest asset manager in the world, BlackRock, of course, with a trust and investment vehicle for Bitcoin. In a world where Gary Gensler is like, a concrete block trying to prevent progress. Well, maybe he's got his good reasons, but he's still there. This is like a sort of crack in the matrix, right? Of reality. If Bitcoin really is this bad, really is this corrosive, then why is the largest asset manager in the world jumping in? Obviously, because it's got the backing of service providers like CF Benchmarks. They're using the CF Bitcoin New York TWAP, a sort of bespoke index. I had to look that up because it's got a long name. So basically, Peter, the process of reeling in a BlackRock, I think, will be really instructive for a lot of people who are listening. How did that all come about?
Yeah, I think with them, and again, you see all the negative headlines about crypto constantly, or bad press, or people, all these different blogs, YouTube, anything social media wise. But a lot of it that you don't see is these large asset managers, such as BlackRock. They've been researching the topic for quite a while now, and they have internal teams that, and our key, points of contact there. They've been there for a while, and they've been looking at the space, and they've been onboarding the correct vendors. They've been, really doing the due diligence and taking their time to actually seamlessly and, launch the product that they launched with us, the Bitcoin Trust, in a very, regulated, well done, seamless, like took their time, did their due diligence on each third party that they're using to launch the product. And again, it's a very institutional grade product. It's a trust in the sense it's similar to the other trusts that have been launched out there, but it has, very institutional minimums, and it's geared toward, them launching their first spot product to test the waters with institutions and go that route. Yeah. But it wasn't something that was just launched overnight.
Cool. Okay.
So Peter, when we look at the US landscape of crypto asset managers, I think we'd all agree that BlackRock entering that space, despite it being a private trust, frankly, it's a kind of a big deal, because you basically have the largest asset manager. This is the big one that if it puts the stamp of approval on, some sort of product tied to Bitcoin, in this case, a direct product that's investing in a spot Bitcoin, it seems like this is the type of circumstances that can get kind of the dominoes to start falling, and maybe the SEC, historically has been kind of looking at these applications from these smaller asset managers trying to get spot products approved, and they're just not confident in the resources that they have, the depth that they have of their teams. And when you get someone like BlackRock, to kind of step forward to start to dip their toe in, do you think that this is, kind of consequential for kind of the next phase in the SEC reconsidering maybe their approach with spot ETFs here in the America, in the US?
Well, that's the hope. And I would say that, again, it's the larger, the State Streets, the BlackRocks, the Vanguards, the very large asset managers who, if you think about when Barclays Global turned over into iShares, I don't know, 20 years ago at this point, or a little bit longer, people thought that they were crazy for trying to capitalize on this big ETF, opportunity, because people only bought mutual funds. They bought mutual funds and stocks, and they bought, different, now outdated investment vehicles. And, going into someone's office, a financial advisor, or, in Chicago here, like let's say where I'm living, if you were talking about ETFs, passive fund at that time, 20 some years ago, they would not have taken your meeting or thought you were crazy. And now you look at the iShares business, it's a multi-trillion-dollar business. So they were able to, really capitalize on this change and shift from fee compression and just more transparent, easier vehicles to invest in. And that's where we've seen, like, when they decided to, and, Larry Fink has had very positive stuff to say about blockchain, digital assets, crypto, everything over the past couple of years, and seeing them, go full on with launching, even though it's a very, again, institutional product, seeing someone with that caliber step into the marketplace with a great understanding of it, I think is a drastic shift and gives a lot more people confidence, and gives a lot more of the, if someone is willing, as a BlackRock is willing to, put their reputation on the line and dive into digital assets, it's very good for the traditional asset management world, traditional financial services, and the digital asset world to see someone who's willing to, adopt this technology.
I mean, so it's persuasive for the industry, it's persuasive for the managers and other types of product providers. Is it persuasive for the regulator, and maybe the most important regulator, the SEC? Yeah. Do you think? How do you think the SEC regarded that news, and was it in any way an influence?
Well, I think, just real quick, kind of what Peter was just saying, I just want to jump in real quick, because I think he hit something kind of very important when he was talking about the fee compression and what the ETF movement kind of, brought into the investment world for consumers, for investors, retail investors. And when you look at the current environment and landscape in the US, there's this, on one side, you have this big push to go to more fee-based fiduciary type advisors. Okay. And on this side in the crypto, you don't really have too many vehicles that are, I think, efficient from a cost perspective that advisors could, utilize for their existing book of clients. And so when you're a regulator and you're trying to, protect end consumers and investors, I see these two forces kind of coming together head on, because kind of the existing regime with the current framework is frankly kind of limiting, I think, some of these better options or alternatives for the retail client to get exposure, through their traditional advisor distribution channel. So, I'd love to get Peter's take and, hear more of his thoughts on this, because I think it's pretty apparent the way these two forces are going to be colliding here soon.
Yeah, and that's a great question, and it's obviously with a majority of the CFB team and Ken as well over in the UK. The UK and most of the European markets are very different in the sense, from the US markets, where the financial advisory space controls the wealth here. It's whether you're in a traditional, as they call them, wirehouse representative, so the Morgan Stanleys, the UBSs, Merrill Lynch's of the world, versus, as Gabe was alluding to, a registered investment advisor, a family office. They're really controlling, a lot of them are pushing these types of products that the large asset managers are launching, because of the amount of wealth that can pour into these products from a day one. And with the current existing marketplace out there, there's, as the trusts, there's separate accounts, there's, the futures-based ETFs, there's the ability to have kind of a bolt-on where you can go direct through an exchange like Kraken. There's a handful of different types of vehicles with not a perfect vehicle by any means. Mm-hmm. And a lot of them are a bit more clunky. They do have higher fees. If you think about some of the large ETFs out there for the plain vanilla equities that are 5 basis points or 10 basis points, where these crypto trust products, a lot of them are 250 basis points. So it's a massive flip over to even higher than, a lot of the mutual funds are charging. And I think from a regulator's perspective, there's pretty much everyone's tried to find a way to go around the regulator, and, because ETFs are not allowed. And getting an ETF, opens the doors, especially from a retail perspective, for people to finally cleanly access, this type of digital asset landscape. Primarily just Bitcoin would be the first one, but it at least allows for a cleaner way. And a lot of people, who are, registered investment advisors or fiduciaries, who understand digital assets, for them, the ETF is not the cleanest way. For them, it's the easiest way and the cheapest, most effective way is to use a Kraken, is to integrate with Kraken, to buy it through their, to hold their wallets. But for the majority, for the 98% of the other advisors out there, that's so clunky. And for most of them, like the large banks, the Merrill Lynch's, Morgan Stanley's, they cannot, their compliance will never allow them to do that. So they need a product in an ETF wrapper to be able to access for their clients, as well as, like my parents' generation, whether it be through their advisor or just if they have their own investment account that they want to run, they can at least access, that through a Charles Schwab or a Fidelity, to be able to buy that. So that's why I think that this, approval of an ETF just opens, the amount of vehicles that people can access to, where you really can pick and choose versus being forced to use something that may be a bit more clunky.
So we talked about some of the resistance in terms of the exact avenue that you take to actually get exposure, but more fundamentally, you're obviously going to be a lot more familiar with the exact nature or quantum of resistance that you're seeing from asset managers, investment advisors, and so on and so forth, to be involved in cryptocurrencies at all. So what are the sort of like the really top level points or contentions that you're hearing still in 2023 from people as to why they don't want to offer a crypto product or they're reluctant to?
I think most of them, especially it's, from top down, the people at the top are not convinced that it's worth the efforts or worth, because, you look at a BlackRock who already had a digital assets team develop. A lot of these asset managers, one, would have to hire a lot more people that are very crypto savvy, but also traditional, come from traditional financial services, or they have to move people over from different departments and say, now your focus is digital assets. And a lot of them are very cautiously optimistic. So it's, I think a lot of them want to see, as much as BlackRock was, that was great news for the whole traditional asset management world, they want to see more. They want to see others really dive in, or would love to see that exchange traded products are going to get approved on exchanges in the United States.
Yeah.
And most of the pushback is, and even for the firms that have developed digital assets teams, they would love to launch DeFi multi-asset portfolios. Like, they'd like to take, the CF DAX and build stuff off of that and use the taxonomy because they see the value of that compared to, as compared to GICs and being able to build out a whole suite. But the people at the top are just saying, no, it's not time. We don't want to waste resources. And a lot with, I deal with a lot of lawyers and legal teams is it worth the effort to go through all this stuff from a compliance perspective to then just be shut down? So,
reputational risk as well. We talked about in our little, that's still, people kind of overlook that. I certainly overlook it. But you start talking about this stuff in some venues, in some boardrooms. Is it really still that much of a sort of neutron bomb on your career if you start mentioning crypto, or you're indicating your interest in sort of bringing that kind of access?
Well, yeah, I think it's similar to, when Gabe and I worked at Deutsche Bank, and, even though we were not affiliated with a lot of the stuff that was on the negative headlines, you get clients asking, your end clients end up asking, hey, what's going on with that? Or, and where if you can stay out of the press, it's a good thing. You don't want to enter a space and then immediately get questions because the first time that you've had bad press is for 5 years has to do with something that people say is, still affiliated with criminal activity. And that's where I think it's still a very big issue for a lot of these large firms, because they don't, if everything's going well, what is the reward for entering the space? Which obviously we disagree with that, but that's because, we spend all of our days where realistically, most of these teams, if they don't have a digital assets team, they're spending a couple hours a week. It's nothing. They still have to worry about alternatives, fixed income, traditional equities, because that's 99% of their business.
Yeah.
And what's that really famous saying? It's better to fail conventionally than to succeed unconventionally.
Yeah.
It's kind of this this mantra that I think applies well in this instance. But to be frank, I think if you look at what happened in 2022, we had all these shocks in the
wasn't a great advert, was it?
All these headlines, right? And I think that really if we could single one out, it would have been the collapse of FTX and Alameda, which left such a bad taste in everyone's mouths, and I think got so many or got the attention of the political cohort here in the US to kind of cause action. That was really, I think, the a key moment for kind of shifting to be a lot more hawkish towards crypto here in this country. And I think, Peter, it's really good to get your perspective on these things, because you can really go into the weeds and discuss some of these topics that I would say a lot of people aren't really aware of. Like, what are some of these into the weed type issues that when you're an asset manager and you're considering the space, is there some sort of important agreements that you have to have, or what would be something that would kind of hinder them as far as entering the crypto space for them?
Yeah, it's that's a great question. I think a lot of it, especially very large organizations, are not as nimble as a CF Benchmarks is, for instance. So, a lot of it is connectivity to their systems to be able to, for us, we're using APIs, SFTP files. Yeah. We're integrated with Bloomberg, Refinitiv, a handful of providers of that sort. But not everyone has a Bloomberg terminal at these large asset managers, or not everyone can digest the data in the same format. So a lot of it is seamless integration, because they don't want to have to reinvent the wheel in terms of how they're digesting data from traditional providers, as well as a lot of it with, stuff like, fortunately for us, the FTX collapse obviously tremendously affected the landscape, but wasn't part of, as an example, wasn't part of our constituent exchange list. So they were never going to be in our calculation for our indices. We benefited in a way from them collapsing, just in the sense that it showed our processes were so well established.
Inviolable.
Yeah. And that's what providers look at. They would have been much more concerned if FTX was in there, because then it's just more explanation around that to their end clients. Their legal, their compliance, their leadership, as well as integrating with certain, when trying to get products approved, like with the SEC. When I was at Bitwise, a lot of it was around volume and market manipulation, and now it's a lot of it has shifted more, in my opinion, to talking about, as you alluded to, Gabe, information sharing, as you would with a traditional equity exchange. If you were to launch an ETF, they have agreements between the exchanges and the regulatory body and the asset manager to be able to share information if there is that type of illegal activity or stuff that could be market manipulation, which hasn't really existed in terms of that landscape. So there's a bunch of those behind the scene factors that kind of everything has to line up for these firms to, in the United States regulatory regime. That's kind of where a lot of everything has to align correctly for this stuff to potentially work.
I mean, yeah, it's I've always heard the market manipulation hurdle, and I think you're the first one to kind of share this other one, which is information sharing. For me, to kind of get to know that one, but that's just a very interesting, I guess, hurdle that we have to clear now. So yeah, Ken, do you have any other questions?
No, what I was thinking is, to bring it all together, because we've sort of we've really touched on the sort of main points. The ideal model that, in theory, because we don't know, we're basically in the dark here, guesswork. But in theory, we've sort of arrived at the ideal structure of a spot Bitcoin product, listed spot Bitcoin product that the SEC could potentially approve. It needs to have, it's Bitcoin, it could be any crypto asset, but let's start with Bitcoin, probably most likely to see that first. It needs to have some sort of information sharing agreement structure within it. It needs to potentially be offered by a large firm to offer the buffer in terms of resource, manpower, legal, to enable it to sort of withstand all sorts of shocks that can come, unpredictably from the market. And basically, of course, it needs to have, the most watertight, in terms of integrity, service providers backing it, including companies like CF Benchmarks, in order to actually pass that muster. Now, really, as I say, we are getting to this stage just by a process of deduction and basically extrapolation. There is no rule book. That's the infamous contention that everybody has, right? But is that what it would look like? Is that what an approved, listed US spot Bitcoin ETF would look like in your view?
I mean, I think that you hit the nail on the head. That's kind of, all the stars, those stars need to align for the SEC to feel comfortable. And I think that, because of the more esoteric products from an alternatives perspective, let's say that the large institutions have launched in the past that now may be in a mutual fund or an ETF wrapper, they've seen those large institutions are not necessarily just crypto native firms. So I think a lot of them have experience, getting these more derivative based or, again, alternative type products in an ETF wrapper. And they have the infrastructure and the headcount to be able to facilitate more esoteric type products. And, having the experience, I think goes a long way with the regulatory bodies. And they just want to see it done well, because it, like, in the end, it's the general public here in the United States and the institutions who are the ones that are buying and absorbing these products. And with the traditional asset managers being able to have, again, like with the general public, because a lot of them, as Gabe, alluded to before, was having a fiduciary responsibility as an investment professional, regardless of whether you're an RIA or an independent advisor or a big wirehouse bank advisor, or you're an institution or an outsourced CIO, consultant. You have to do your due diligence and do what's best for your clients. And that's laws that have been more implemented recently because of past problems within the investment world here in the United States. Was the end client is the most important client, because they're the ones that are really taking in these products, regardless whether they're doing it themselves or having someone do it for them. And with crypto being such a volatile asset and a much newer asset, on the other side of the spectrum, there's lawyers knocking around that are waiting for this type of opportunity to sue someone for making a poor investment decision based on an asset class where they didn't understand the volatility and the risk. And that's something I think that is, but we're there to help. That's our job. When you're picking an index provider in such a volatile space, all the processes and stuff that we have in place allows us to stand up to that scrutiny, where if there is a problem, where the SEC or any other regulatory body has a problem, or there's issues that bring up, we truly feel that we can stand up to all of that scrutiny because of what we have in place and our tenure in the space that allows us for hopefully what we would see, a product eventually get launched, because we're part of that ecosystem within the large asset management firm that allows them to feel comfortable with going through this.
Well, it just seems like a no-brainer, really, that there's a better vehicle, right? There's a better way in the current landscape to provide end clients, exposure to this asset class, which is just growing in popularity. So,
right.
Very well said, Peter. And that was a great summary, Ken, by the way. If there's any regulators listening, you've you've drilled it down.
Kind of set the standard.
Yeah.
But the point is that, what the thing that really always makes me second guess myself with that particular aspect, and both of you, either of you can sort of like address this, is I just find it really weird that this is the process that we actually have to go through to actually get to the end goal of a listed Bitcoin product. Let's talk about a listed product in the digital asset space in the States, where there's clearly demand, where there's clearly a public interest, where there's clearly a sort of a public safety issue, which is what the SEC is there for in terms of consumer standards.
Right.
The job of the regulator and sort of other agencies of that nature is to bring about that change, to allow that future to occur in the most safest way possible. I don't think it's really the job of the regulator to basically shut it down. So, and then not to provide any guidance, right? So although I've laid it out, I could be entirely wrong, because we don't know. There is no playbook, right? Is this generally how things work in the States historically?
Digital assets has definitely thrown a curveball at people, because I think it's trying to, for one, decide if all of these other coins tokens are securities. And that's where I think here it's very unsure. So the focus is heavily on Bitcoin and Ether. That's where people don't want to dive past that, because as we've seen, a lot of people have been fined over here for promoting projects that are technically securities, and getting fined millions of dollars is nothing that anyone wants to happen to them. So we've seen the focus on those two, and with the regulatory bodies really overseeing this, like hawks, specifically crypto assets, was you just have to be very cautious, but it's new for them as well. So they're trying to understand this. And just as, the rest of the traditional financial services world spends minimal time on crypto, so do they, where it's, we spend all of our day talking about digital assets, where for them, it's a widely publicized topic, but it's not necessarily top of mind for them.
Yeah. We're on the subject of regulation very broadly, and maybe we can sort of like stretch that to the law, because we have a number of things happening in this space right now which are really important. I want to ask your opinion on this, Peter, because I think you're going to have an amazing perspective. So clearly, we do have, I believe, the manager of the still the largest crypto fund, that's listed in, it is listed in a sense, and you know what I'm talking about, Grayscale Bitcoin Trust, at loggerheads legally, actually in court with the SEC. And the issue is whether the SEC's decision to reject Grayscale's application to convert Grayscale Bitcoin Trust into an ETF was flawed or not. And, the reasoning, the basics of the reasoning is that we now have spot Bitcoin-based ETFs, futures-based ETFs that are linked to Bitcoin. The most obvious one is the ProShares Bitcoin ETF, BITO. It basically is a CME Bitcoin futures-based ETF.
Right.
And so therefore the contention is that because the price tracks Bitcoin, the price of the futures tracks Bitcoin very, very closely. There's a vanishingly thin difference between the price of Bitcoin futures and the price of Bitcoin. I mean, that can change, but in principle, it is, it is there. And also the SEC has approved futures-based crypto ETFs under the 1933 Act, a crucial bit of minutiae. So, a more onerous level of scrutiny and oversight is implied.
Right.
Having done that, how then can they argue that a spot-based Bitcoin ETF should not be approved? And that's essentially Grayscale's beef with the SEC. Yeah. Do you think it holds water?
It's a very tough question. And again, despite both my parents being attorneys, I am not an attorney. But I think it, and again, kudos to Grayscale. I mean, it's the longest running GBTC, is the longest running digital assets product. I think at a certain point it peaked at, $60 billion or something. That's a very large fund. Yeah. And I think that there's a bunch of different angles you could go from it. And when I was at Bitwise, our, top competitor in the space was Grayscale. And we launched, similar type trust products. And that, from an SEC's perspective at that time, it was really, they hammered home market manipulation and, fake volume was a big issue with a lot of the exchanges. And I just don't think that the market was mature enough at that time, 5 years ago, for an ETF product. I think it was just not ready. There were a lot of bad actors, as we've seen, just months ago. There still is a lot of bad actors in the space. I think a lot of them have been cleaned up. I think that they continue to be cleaned up. But I think, for one, there still is obviously the debate whether the SEC or the CFTC should be regulating digital assets, because they're technically commodities. And the CFTC already regulates the futures market for digital assets. But I think that a lot of it was justified, but a lot of it, there's gray areas. And I think that the market's matured enough, and Grayscale has been making very good arguments in court to justify why the general public needs this type of vehicle. But I think, as we talked about before, we were talking about the different investment landscape and types of products that exist, those types of products are by no means a perfect product. And I think that a lot of it, when initially, which, you can point fingers at whoever you want, but, the conversion to what is in the OTCQX, I believe that the marketplace is, for the over-the-counter products, which technically trade as pink sheet products. It's, you can, do the conversion. They're trying to convert the trust to an exchange-traded product, where you can convert the trust currently to this OTCQX market, where that's where a lot of them trade as, at a premium or a discount.
Right.
And I think that there was a large uproar in the bear market in Bitcoin, especially with when you see the price dispersion between the trust product at net asset value versus what's trading in the open marketplace.
Yeah.
And again, you can point fingers at whoever you want for this, but when it trades on a lot of brokerage platforms, those types of product, not just Grayscales, but the other ones as well, they appear as an equity product or an ETF product because there really is no widget or window for an OTCQX, which millions of people thought that they were buying an ETF product that would trade at NAV. And that just wasn't true because these products haven't been high demand in the United States marketplace for years. And, that's where a lot of penny stocks trade. So, I think that there was a large uproar from when I first started Bitwise, there were a lot of the advisory market that, felt that they had been screwed on this because frankly, they didn't understand the product. They thought that they were just buying an ETF. And I think that I'm sure the SEC is a bit frustrated that they've been very vocal that they're not allowing a spot product. So people have launched vehicles to circumvent them so that, there is the boilerplate legal language from a Reg D product that's more for accredited investors, or even they have Reg A type products for even higher net worth individuals. But then when those get converted, and it's they've been dealing with a lot of people trying to get past them for this. So, but I think that Grayscale's arguments now are very sound, and it seems that the judges in a ways agree with that. But then you bring in the issue of the new custody laws as another potential roadblock that they can implement. And I think you can argue on both sides. It's very tough to pick a side, but on like a different note, I feel that we obviously feel, and as you and our CEO Sweet Chung worked on the Bitcoin analysis, the BRR analysis paper 3 years ago. So now we have the new updated version. If I was reading that, I would say that the market is more than ready for a spot ETF product. I just think that, as you alluded to, those steps, those have to be hit. And there is other stuff that allows you to go above and beyond, which I think some people behind the scenes are doing at the moment. I think that the market is ready for it. It just depends on what is going to check all these boxes for the SEC to finally, get this out in the marketplace.
Sure. Gabe, did you have anything else to bring in about this or something else?
No, I was just gonna say to be continued then, right? This is this is the topic here, is to kind of be following the progression of this, and certainly the Grayscale versus SEC case has been really eye-opening, I think, for a lot of folks, and surprising in some ways. Like Peter was saying, it's we have seen some constructive things kind of come out of that seem to be reported on that. But to me, if Peter, you really kind of dissected it from all these different angles, but it kind of keep arriving to the inevitable: what's best for the end client, what's best for the investor. And certainly, where we're at right now, just it doesn't seem like it's an acceptable place to be for retail investors, or for anyone really to kind of try and gain exposure to it. So TBD. We'll have to just wait and see, but it's been an absolute pleasure.
A long time.
Having you, I think, on the podcast, Peter. And if you've got anything else, Ken. We have come to a sort of natural point where we could wrap up. We've been talking for a while. We could probably talk for a while longer.
Hours,
just broadly speaking, what are you working on right now that you can tell us about? Obviously, that's going to come to fruition in the near term. That's going to be of interest to listeners and watchers. It's
a lot of it, and my time is spent. I wish I could spend more on DeFi and more stuff past Ether and Bitcoin, but it's primarily spent with institutions trying to all get them comfortable at some point down the road with, depending on what, it doesn't have to be an ETF wrapper. It could be a mutual fund. It could be a separately managed account. It could be an on-chain product. It could be something that is, even more esoteric than some of the jurisdictions that allow for that. But primarily, and I think a lot of it, which is big for the industry, is selling or more education. It still is hammering home education. And a lot of the stuff that we're doing is well and beyond what any other providers are doing. And probably for most is too far down the rabbit hole in some ways. But we're building the same content and, mostly attributed to you two guys, like, the attribution reports, a lot of the analysis papers, a lot of the podcast information is stuff that when people that are skeptics finally do step in 3 to 5 years down the road, we have everything that a traditional index provider has. So it's more building relationships for when people do hop on board, that we have the full suite of information to help educate the team, no matter where they are in the journey. So it's more of, trying to introduce myself and my colleague and counterpart, Charlie, to be able to have these conversations over the course of, could be 5 years. But really spending, hand-to-hand combat with these large institutions in the consultant space and, asset owner world, to really be their trusted resource as an index provider in crypto assets. So that's really where I spend the majority of my time, and that's fun. Educating people about the space is truly fun as a business development person. Being able to educate people on a space that changes every day is what's really exciting about the job.
Yeah, that's brilliant. Beautiful. Is there anything we haven't touched on that you wanted to mention at all, that we can sort of do now at all, Peter?
No, I mean, I would say, and I would harp on again, just that, and again, Ken, as we've seen the progress from when we started, even just what the website looks like compared to what it is now, adding someone like Gabe, our whole team's expanding constantly, that just more, people that do watch this, please use this as a resource. I think that we really do have the educational tools and, with Claire on digital presentation as well and design, our stuff looks a lot prettier now. And it's very, we have a lot of presentations, we have resources, we have the data, everything is transparent. We have truly everything now. And as we keep adding to it for people to educate themselves in digital assets, depending on where you are, whether you're on the ground floor or whether you're on the 100th floor, we have stuff that caters to everyone. So, I don't want people to forget that education in the space is the most important thing. So please, please use all of us as a resource as you dive into that journey.
Yeah, and when you've educated yourself to a little degree and you're ready to take that final step, give you or Charlie Joel, if you're counterpart in Europe, a call, right?
Yeah, please do.
Yeah. All right. So yes, that's just about it. It's been a really scintillating and I hope insightful and informative conversation, the type of information and conversation that you're unlikely to be able to get anywhere else, because we do have another unique guest in Peter among us now. We are so grateful that you've joined us today, Peter. And we do hope you'll come back again to give us a little bit more insight, maybe in 6 months, maybe a year.
Yeah.
Who knows what will have happened by then, right? So thanks a lot again to you, Gabe, and again, Peter, and you guys who've been listening and watching. We'll join you again for another episode of CFB Talks Digital Assets. See ya.